I think there's a very good chance we get some very, very, very significant turmoil next year. Would not at all be surprised to see markets down or barely up. But the ride along the way, I think it's highly likely we see a true bear market. If you use 20% as the metric, I think it's quite likely we see a pretty sizable drawdown next year.
Welcome to Thoughtful Money. I'm Thoughtful Money founder and your host, Adam Taggart, welcoming you here for a special end of the year recap with the team at New Harbor Financial, one of the endorsed financial advisory firms by Thoughtful Money. I'm joined as usual by lead partners John Lodra and Mike Preston. Gentlemen, how are you? We're recording this interview right before Christmas Eve. So let me start just by wishing you both a very Merry Christmas, even though this will be running after Christmas.
Hope you have a great Christmas too, Adam. And here we are on Christmas Eve. And yes, I know your viewers will see this after Christmas, but certainly looking at the market has delivered holiday cheer, hitting a new all-time high here today on the day before Christmas. And this is a shortened holiday day as well. And so hopefully this continues for some time. We'll see, and we'll talk about it today.
Adam, I'll just add my Christmas wishes to you and your family and your viewers. I'm joyed to see that we have a white Christmas here outside my window here in Massachusetts, and just makes for a nice little twist to a special holiday for a lot of people, including my family.
All right, well, that's very nice. We're back in California visiting my wife's family for the holidays. We're having a very wet Christmas here. Probably part of the reason why you can hear from my voice. I am a bit under the weather here. I'll apologize in advance, folks. I'm going to lean hard on John and Mike in this discussion because my head feels like it's filled completely with cotton, except for the 100 gorillas with sledgehammers that are trying to bash their way out of my brain. So yeah, this flu I just tested last night. I've got the influenza A strain, I guess. And I'll just tell you, folks, it's not as fun as it looks. So if you can avoid it, I would recommend you do so. But anyways, on to more fun topics. So Mike, as you said, looks like Santa has arrived on Wall Street. We're getting a Santa Claus rally. The S&P is at a record, I think, pretty much as we speak here. As are the precious metals, which we'll talk about in just a moment as well. It's been another hell of a year for the markets. We've had 20+% returns in 23 and 24. Pretty improbable to have another really big up year for the third year in 2025, but that seems to be what the market has now delivered. Looks like it's going to be close to like a 18% return or so for the year. I guess, why don't you tell me about what indicators you guys are looking at? Is this kind of giving you guys the green light going into 2026?
I wouldn't say to get too excited here. I mean, our suite of indicators are solidly bullish. They're in the green zone, and we're starting to see some broadening out. But I'm going to share some charts here so we can take a look at a number of the different indicators, or at least a number of the different charts. So that should be up now. This is the S&P 500. And as I mentioned, we hit a new all-time high. So there's the new all-time high as of right now, 6,937. But actually, before the last couple of days, you could go back to late October. We essentially went nowhere for about 2 months. And here, just the last couple of days, we eked out a new all-time high. Not that much to get excited about, other than it is an all-time high. And don't forget, there's still a few days left in the year. So even though we're up 18% or so, as you stated, who knows where we're going to be at the close on December 31st. And another thing we've noticed is that we started to see a broadening in the market. So if I change the symbol here and we start to look at the equal weighted S&P 500, we can see that we had about 2 weeks ago, we hit a new all-time high. So here's a broadening. Now it's done some backing and filling here the last week, not at a new all-time high today. How about the Russell 2000? The Russell 2000, same thing. We're broadening out. These are good signs for a broader rally, and it immediately backed and filled. The NASDAQ is not at a new all-time high today, still struggling about, maybe a percent or two below an all-time high. So what is this really saying? We've got to take a look at what the indices are actually doing and combine that with our bullish indicators, which, you have to be careful. You don't ever know what the immediate future is going to bring. But now that we're back above the 50-day moving average, we've successfully tested that 50, and 50 is the red one, and the light blue is the 21-day moving average, and we're at an all-time high. There's a much higher probability that we're going to get a squeeze to new highs. And so if I went to weekly, you can see that we went nowhere for 2 months, as I just said, and now we're coming out of that base that could be a launch pad well up into the 7,000s. So everything really you need to think about the risk control, but if we had to guess, I think we're going to get a squeeze higher here in the next few months. And so we're not trading aggressively from that perspective. I'll stop sharing. We are nudging up our equity exposure just a little bit. We were at 45% equities. We just increased it to 47.5, increased it by 2.5. We have very few covered calls or hedges at this point. If we get more extended, if we start to go vertical, we'll start to add, I think, some more hedges, particularly covered calls. We may even reduce equity into that ramp, depending upon what the other indicators are saying. But for right now, it is green light, and you have to be careful about getting too aggressive because, the macro and the valuation says that we could easily, be a lot lower than this in the market. We just don't know when that turn is going to come. So, number one goal here is to try to make returns for our clients, but not give back much on the turn, and that's what we're trying to do. Right now, the arrow is pointed up.
Okay. So despite your concerns about valuations and whatnot, we've long talked about how while they're a good indicator of risk, they're a bad indicator of timing. You are becoming more optimistic in the near term about where things might head.
That's true. It's probably a warning sign. So, for your viewers, I mean, they may think that, hey, New Harbor is getting more bullish here. Maybe that's a contrarian signal. Maybe it is. But just remember that what we're talking about here is very modest. Like I said, going from 45 to 47.5 is not a big move. And we have the discipline on the downside. A lot of people are passively long this market. Those are the ones we worry about. If we start to go down and take out our stops, we'll retreat pretty quickly. So we have an active strategy versus a passive strategy. And I'm just saying that the stars are starting to align to a condition where we could easily get a squeeze higher. And like I've said before, I think on this program, watch for something like 500 S&P points up in a short period of time, 2 or 3 weeks. I think that'll tell us that we're real close to the end and that the blow off is here. That's only one of many scenarios. Right now, I'm guessing based on the broadening that we might be building this blow off. And again, if we get that big up move, that's not a reason to jump in. That's a reason to get more defensive. And we'll be talking about it here.
Okay, and I'm glad you mentioned that. So you have for a while now, I don't know if I want to say predicted, but you've said your expectation is that wouldn't surprise you if this large bull rally that we've been having would end in a blow off top like that, and then that would be a high point, obviously, and then you think that there could be a quite material correction that could follow. We're not seeing the blow off top yet, but you're basically vigilant for it, I guess is what I'm taking.
The variables are starting to align for it, is what I'm saying. And it certainly hasn't started yet. Again, some of this is guesswork because nobody knows the future, but it really has to do with the time that I've had in my career since 1999, that this bubble's been going this whole time. And every little correction has been rescued with more money printing. And the only thing that's really making sense now at this point is some kind of blow off top. And again, we're not trading from that perspective. We're not relying on that, but that's what it's looking like right now. And if I had to quantify this guessing, like I said, look for 500 S&P points up in like 2 weeks. That would be like 5 to 8% in a couple weeks' time. If that happens, that doesn't mark the top either, but that means that theory is right, and it means be careful because that means we're in the final moves. So that's,
Okay. Well,
again, I don't want people to go more in. I want them to actually start thinking about pulling out if that happens.
right. And so we'll have you guys obviously on this channel weekly, as usual, going forward from here. So if indeed we start seeing that type of price movement, you can flag it in real time for folks.
Will do.
So John, heading over to you. So as Mike said, in the near term, sounds like you guys are getting more comfortable with opportunity in the market. You've increased your equity exposure a little bit. Your indicators, as Mike said, are pretty green. So Mike also mentioned that the breadth of the market seems to be increasing. Again, those are healthier signs. So as you look into 2026, what do you see as driving the markets? Is it going to be more just the hyperscalers again, or are you expecting to see capital rotate more into the other parts of the market that have been a little less loved in the past year or two?
Yeah, that's a great question, Adam. And in a word, we do think there'll be rotation. In fact, we're seeing it. We've seen some pretty, notable rotation underneath the hood of the market. And we as much as anybody are guilty of talking about the market as if the S&P 500 is the market, and what it does is what the destiny of investors is. But that's not really the case. And perhaps I can just, by way of illustration, share one of our dashboards. This is just one of many tools we look at. But this is a sector relative strength kind of dashboard, if you will. And just some quick deciphering this for viewers. You have the various stock sectors across the top here, technology all the way to consumer non-cyclical. I've got this sorted by weekly, going back a couple of years. And the simple kind of way to read this is, the green, this is a relative strength screen. It's a systematic measuring of price action of every sector and constituents of that sector relative to others. And by and large, you want to look at folks, sectors that are in leadership and have momentum and trending. So you have, for example, on the right hand, technology, communication services, industrial, basic materials, financials. And at the lower end, you have some of these sectors. Now, what you see is these don't statically hold position. In fact, they rotate. And these numbers in the bubbles there are meaningful. They're what we call a tally count, the signal of the strength of the signal, if you will. So a couple of notable things. So for example, look at basic materials. Mike mentioned that we just added a slight bit more equity exposure. We didn't add that to the S&P 500. We added it to a global basic materials, specifically metals and mining. Even within these sectors, you can look at subsectors. And much of the strength, you see these tally counts have consistently improved for basic materials. This is things like copper and steel miners, base metals. It also includes chemicals and things like that. But even within this sector, the real strength is in the kind of metals and mining. And we're not talking about gold miners here. This is totally different, kind of more base metals. And that's actually where we added some recent exposure. Look, on the other hand, you see financials, while they're still in a pretty good relative strength position, the strength of that signal has been consistently weakening. We actually rotated out of some targeted financial exposure a couple of weeks ago in favor of rotating into some basic materials. And we actually did add some healthcare exposure too. That you can see as, even though it's still in a longer term sense, still catching up from a relative strength standpoint, in the near term, there's been some very significant improvement. So these are the kinds of things that we routinely look at and monitor for. So you can have a market that languishes or goes nowhere, but you can have some very stealth, positive developments underneath the hood that you want to be looking for. Energy, for example, if we go back to 2022, the last bear market in the real bear market in the stock market, energy was one of the bright spots. It was, bright green, just to pick a color here. And energy actually did quite well in 2022 when most other sectors, including technology over here, languished quite bad. Energy has been a laggard for much of the last couple of years until recently. We've seen some pretty strong strength. And even within that sector, the oil and gas services companies have been much stronger than, for example, the producers or exploration type companies. So those are the kinds of subsurface rotations that we are not only seeing, but we expect to play out further as we head into the new year. Technology has been losing some strength. And so I absolutely do think there's probably a good chance that we see the hyperscalers become yesterday's news a bit, and other things start to pick up the slack, and probably stealthily. It probably won't be on the headlines, but we'll see it in some of these, kind of systematic indicators that we follow every day.
All right. So let's talk about that. So we don't know exactly what's going to happen, but let's say you're right there and that the hyperscalers become yesterday's news. They have been driving the markets so much for the past several years. Can they become yesterday's news without cratering the markets? Is there a way for them to gracefully cool off and hand the baton to other sectors to keep powering the S&P even higher? Or is so much of the S&P, and of course even more so the NASDAQ, dependent on those very few stocks that if they correct by any, meaningful amount, it drags a huge chunk of the market down with them.
Yeah, that's simple arithmetic. If we do see these very large cap hyperscaler companies start to really, weaken, mathematics are pretty simple. A typical S&P index fund, which is cap weighted, will see that weakness. Now take that same cap weighted index and equal weight it. So those companies have much less influence. You could have the equal weighted S&P do relatively fine, even if the cap weighted is languishing, if those do in fact start to weaken. But you might see small caps start to pick up more. Just because the S&P 500 cap weighted may see some heaviness if these hyperscalers start to lose some allure, doesn't mean that it's everything goes to crap, so to speak.
Mhm.
But you want to be very selective and systematic in picking. And there are plenty of sectors out there that I don't think will be immune from a major market sell-off, but they are much more kind valuations. I talked about the global metals and mining exposure we just added. You look at that sector, it's gone nowhere, more or less. It's been strong recently, but since 2010, it's more or less gone nowhere in terms of action. So there's plenty of areas that are not over hot or overly bubble like
They don't have the froth.
yeah, you just want to be very selective, and broadly speaking, especially for passive investors, you want to greatly reduce your equity exposure, right? We very much think that we're getting very close, even, and as Mike mentioned, a blow off top here is going to be certainly in our minds not just an invitation, but almost a mandate for prudent investors to de-risk. Just by way of mentioning something that just came across my screen, the investment firm Apollo just did a little study a couple of days ago, and they basically said, someone that invested in a 60% stock, 40% bond portfolio back in 2019 and basically just closed their eyes and held it passively till today, that would look more like an 80% stock, 20% bond portfolio. Now, I'll remind folks that not only is that, more heavily weighted to stocks than many people want to be, if that was their initial mandate. It's at a time when the U.S. stock market, broadly speaking, has never been as richly valued as it is now. Now, that doesn't mean that valuation has to matter today or tomorrow, but it matters. It will matter. We are highly confident in the kind of timeframes that most retirees rely on their portfolios to be safe and sound for. And that's just another way of saying we urge folks that maybe are a little bit displugged from their portfolios to take a good hard look, use this changing of the year as a cleaning of house, so to speak, and making sure your portfolio is properly positioned, because we do have risk out there in spades, and valuations being the most dramatic of that.
So, John, just asking you to cast your eyes on the year ahead. What is New Harbor's sort of default expectation for 2026? And I mentioned earlier that we've had 3 now back-to-back strong double-digit return years, which is statistically aberrant in and of itself for the market. A fourth, while possible, statistically speaking, isn't probable. And I know you guys at New Harbor have had lots of concerns about both the economy and valuations in the market and whatnot. What's your default assumption for this year? Is it going to be more of a flat year, another up year, or more of a down year?
Yeah, well, so some of those simple statistical metrics that you just mentioned there, X number of positive years, unlikely to, certainly those weigh into some framing of what's likely ahead. There's always the possibility for those trends to get upsetted, and we don't put too much weight on those simple stats, but you could combine record valuations, you combine the extension. We, as Mike has already alluded, we see the ingredients for kind of a blow off top of kind of thing. There's sentiment indicators that are getting a little extreme in terms of positioning and things like that. Back that up with a monetary and fiscal environment that has suddenly become very accommodative again in words and deeds. The Fed has started to expand its balance sheet again. People will pick semantics that this is or is not quantitative easing. Quite simple. It's stimulus in our view, and it is quantitative easing in the sense that it's printing money, figuratively speaking, not literal printing presses, but these aren't being paid for by base dollars already in circulation. It's an expansion of the monetary base to buy those treasury bills, and this, they're framing it as a reserve support, measured, not true quantitative easing. That's just semantics. And then you've got, the whole drama about who the Fed chair is going to be, and the one-upping of the candidates to who's going to be more dovish, who's going to be more, supportive of interest rate cuts. Yesterday, President Trump put a post out on Truth Social that, if you read it word for word, is like they're going to run this thing hotter than you can imagine in terms of, throwing everything in the kitchen sink at it, and who knows what that means for inflation and stuff like that. We're not that smart. We'll let the market tell us, what the market thinks of that. But this has very much the markings of probably some strength into early next year, but an invitation to sell. And we're not really good, because it's not within our framework to say, hey, next year is going to be X%. Here's our target for the market next year. Take this year, for example. Many people will conveniently forget that in April, we were technically registering a bear market in the stock market. Who would have thunk, right? So the path of how things play out over time is as important, if not more important, than the end result, because the psychology, especially for folks that aren't working anymore, they're relying on their portfolio for their retirement security. That ride has as much, if not more, importance than the actual return number that we see at the end of the year, which is just an arbitrary day of the year, the calendar year. And so I think there's a very good chance we get some very, very, very significant turmoil next year. Would not at all be surprised to see markets down or barely up. But the ride along the way, I think it's highly likely we see a true bear market. If you use 20% as the metric, I think it's quite likely we see a pretty sizable drawdown next year.
Okay. So you've mentioned a couple times, John, you guys are active managers, a passive approach, which maybe did fine, over the past decade or two. We've talked about this a lot. May not be the right approach going forward from here. Sounds like you think just sort of like 2025 was. I mean, to your point, right? If I told you at the beginning of the year where we'd end up, you'd say, "Oh, well, then this must have been a really fun year." Well, no, it was pretty gut-wrenching in the first third of the year, right? So this year had a lot more volatility than the previous 2 years. Sounds like you think that there's going to be more volatility ahead from here, and that the set it and forget it crowd may, they might be setting themselves up for disappointment, and therefore a more active approach going forward for a year like 2026 is probably in better order.
I think that's exactly the way we see it. Fed chair, new Fed chair, midterm elections. There are a whole host of catalysts you might point to, and it doesn't matter which spark, but there will likely be plenty of sparks to join a concert of other concerns, valuations, and extensions of certain sectors. We think there's high likelihood it's not going to be a sit back and enjoy the ride kind of year.
Okay. All right. So Mike, let's head over to you. So one of the things that has been a standout of 2025, we had the hyperscalers, and they continued to get bigger and more essential to driving the market. But also the precious metals really finally came into their own. You had been, I want to again give you props for telling people, you were showing the charts at the beginning of the year. You're saying, look, I think the metals are coiling here. I think they've got some good upside. And the breakouts that you anticipated indeed happened. And I'm going to say they happened even more violently than you expected. So love to get your thoughts just in general on what's happening in the precious metals complex right now. The day we're talking, I think both gold and silver are at all-time highs. Just check, silver futures are at $72 an ounce, which is crazy. Sounds crazy hearing those words come out of my mouth. But the key question for you, Mike, is as wonderfully as they have performed this year, do you expect that momentum to continue over into 2026, or have they just gotten ahead of themselves in 2026, maybe more of a cooling off year?
Well, let me try to respond to that in a brief way, Adam. And you're right, the move in silver and to a lesser extent, gold has surprised me, has surprised us. There's nothing prescient about what we were talking about back then. The metals were coiling. We've been long believers in real assets, the whole debasement trade, the fact that we think we're entering a climax of a fourth turning, and we can see that the central banks have been all in over these last 10, 15 years really had us convinced that metals made sense. And metals were in this long consolidation, which was painful for the bulls. We had the high back in 2011, and gold lost 40% over the next few years and didn't hit a new high, I don't think, until about 10 years later. So let me show a weekly chart of silver. And so this has been really great for us, our clients, and anyone that's believed in this trade has really worked out great. And frankly, it's exceeded my expectations, like you said. So here, this vertical dotted line is the beginning of 2025. This horizontal red line is what we call the triple top over and over again on this program. This is SLV, so this is going to be a little bit off the spot price. This is about, oh, I don't know, $5 or $6 below the spot price. But the spot price and this are the shape of the curve is the same. We talked over and over about a potential triple top at 35 right here. One, two, three. And on that break, we added a small position to our portfolio. We talked about it here. It's been a much bigger move than we thought. I mean, silver is saying something is different. I don't think this is your average parabola or you know your average kind of blow off parabolic move in commodities, which often happens. And I don't think this is at all like 2011. In 2011, we hit $50 an ounce, and we pretty quickly collapsed from there. Here we hit $50 an ounce and we just kept going. And so again, the triple top breakout at 35. We went up, we consolidated for the next 2 months, created this triangle right here. And we were saying, look, this thing looks like it's coiling. And lo and behold, boom, the next 3 months straight up brought us right up to $50 an ounce. That's the old high. And look what happened. We consolidated for about 8 weeks. And the last 5 weeks have just been breathtaking, Adam. You know, we just came out of that $50 range and went straight up to 72, as you said. So the question is, what now? Well, shoot, I don't know. I mean, this trade is getting a little bit hot. A lot of people are talking about it. It's all over Twitter. It's all over the internet. But I don't think I would just say that that's a good reason to get out. I think this is a good reason to evaluate your position and to sell on the way up. We've been telling people to sell back here and here and here and here, all the way up. And a lot of people are really over-concentrated. And when I say over-concentrated, if you're north of 20 to 25% in metals, you really should start thinking about selling into this rally. I don't think we're going to collapse. In fact, I think gold and silver are going higher. I think silver will probably break 100 in the next couple of years, maybe sooner. And I think gold will probably top 5,000, but that's not a reason to not take some of these gains. So we have 5 straight up weeks here. The trade is getting a little bit crowded. So just think about taking some off the table. Gold looks similar. Let me just take a look at gold or show you gold. On a weekly chart, triangle, consolidation, up, triangle. All these triangles build energy. And usually they break into the direction of the prevailing trend. Not always, but that's what's been happening. Gold is here at another high, right along with silver. I should say one thing about the gold-silver ratio. I think I've got the chart up here. Let me share it. This is from stockcharts.com. So if you type in gold, silver, this goes back to, I guess, just the beginning of the year. But back in Liberation Day, we were talking on this program like, shoot, we're up at 102 on the gold silver ratio again, you know, and since that time we came down to 62.76 as of right now. So we're starting to see a more normalized ratio. We could have some argument or some discussion about what a long-term average is, but by my eye, it's somewhere around 50 over the last 20 years or so. So, I mean, that might have some room to compress back down towards 60, but it's starting to get more normalized, which is again supporting my idea that you should start selling some into this rally. And one thing I see with a lot of gold bugs, so to speak, which is, I guess, includes us to some extent, is they don't ever want to sell. I'm going to bring up some mining charts and we'll talk about that as we finish. They don't ever want to sell, but if you don't ever sell, then it becomes kind of pointless to do it. You're kind of sitting around waiting for Armageddon and just waiting to pass on the metal to the next generation. If that metal is now 25, 35, 50% of your net worth, which it is for a lot of people we talk to, start thinking about some reason to sell some of it. And it's often hard for people. I had conversations this week. It's hard because they don't know what to do with the money and they don't want to go back into dollars.
Right.
You know, all I can say is think about something real to do with it. Do something with your house, go on a trip, whatever. Let's take a quick look at the miners. The miners have had huge moves. Here's GDXJ, here's GDX, and SIL, SILJ. They've all had monster moves. Some might say that the miners, particularly in silver, are starting to lag a little bit in recent weeks. I don't know. It's almost like the market doesn't believe that silver is going to stay up here at 65 or 70. I think it might. And if it does, I think we're going to start to see the miners, particularly in the silver area, catch up a little bit.
Yeah,
So
the analysts say that. Do you sense this is like a consolidation, a coiling, like we've seen the metals do?
I think so. Let me go to the daily chart here of this is SIL, the Silver Miners ETF. You can see that we've kind of been going sideways for 3 days. Let me look at the juniors with you here and then compare it to the metal. The juniors have been going sideways for a few days. They've roughly, um, we're up about, what is that, about about 20% in the last month or so. I haven't prepared a chart, but that is about the same, I think, as the metal's been up. But take a look at SILJ here, just going sideways, and then compare that to silver. And silver in the last 3 days has been going straight up. So some people are short term saying, what's going on here? Are the miners suggesting that we're at a top? Is the market not believing the silver will stick? I have no idea. And making short-term predictions like that's dangerous. And it's all over Twitter. If you look there, a lot of people are saying, well, geez, the miners are suggesting a top in silver. I don't really want to play that game because as likely as that could be, it's equally likely that the opposite might happen, that we might actually see silver miners catch up and launch out of here. If you look at SILJ, for instance, you take this base right here. This is the cup and handle base. The cup's here, the handle's here. And you see that we've got around, what's the depth of this thing? From 21 to 26 anyway, maybe even 27. So that's 5 or 6 points. If you add 5 or 6 points onto this, you're up at around 32. That's the next reasonable target for SILJ, for instance. And it's probably going a lot higher as long as silver doesn't collapse. So we'll stop sharing now. Nothing in the market is easy, but all of these indicators point higher. I believe the miners in general will continue to outperform. And that's in general what our indicators say, particularly in the gold space. The miners are outperforming the metal. And be careful calling a top. I've learned that you can't really call a top. All you can do is sell on the way up if you're already in it. And that's what we're telling people to do.
Okay. And on that point, Mike, to the folks who've been accumulating physical ounces. So let's say they're of the mindset of, I don't really want to sell those ounces, Mike. I plan to hold them for years, decades, right? Um,
Hmm.
uh, and yes, silver could correct, you know, from here and maybe has a down year next year, whatever. But I feel like in 5 years, it's going to be a lot higher. In 10, 15 years, it's going to be a lot higher. So what would you recommend those people do to hedge, right? If they don't want to sell their ounces, but they don't want to just be sort of naked long their position.
The first thing I would do is I would challenge their statement that they don't want to sell their ounces because that's part of the problem sometimes is they just don't ever want to part with that gold or silver and they should start to think about some of that. I've had a bunch of conversations this week and I can think about three in particular that I actually helped them sell some of those ounces. But if they absolutely definitely don't want to sell those ounces, I would review with them what portion of their investable assets are those ounces. If they're north of 20 to 25%, then that gets into the slightly heavy position because we've long said 5 to 10% is what you should have in your investment account. But if you think about it, we've been saying that for a lot of years. And those people that took our advice might actually be at 20 or 25 or even 30% now, depending upon how the rest of their investment assets have produced. So we want to challenge that notion that they don't want to sell. But if they literally absolutely don't want to sell, It's a tough one, Adam, because the only real way around that, I think, is to use inverse ETFs, which I really don't like, particularly the leverage ones, or options. So if I guess if they wanted to use an inverse ETF, I would tell them to definitely don't use in a leverage one, use a non-leverage one, that might go short the miners to offset some of your position or short the metal, or we can talk to people about how to use options. The thing about options is it's buying insurance and it's expensive. So literally just buying puts on gold or silver is something we can talk to people about, but it's going to cost money. And so if you don't want to sell, which is what you really should do, that's the cheaper, easier thing to do. We would talk to you about buying puts. And we're happy to have a one-on-one conversation with anybody about how to do that. And just have to look at it as buying homeowners insurance or something like that, because it's going to cost some money to do it.
Okay. So thank you. You took it where I thought you would, and I appreciate you offering to help walk viewers through it who might be interested in learning how to potentially do this. So rightly or wrongly, whether for the folks that just don't want to give up their physical ounces, but do want to have some downside protection, yeah, you can you can use a hedge like buying a put, and it doesn't even necessarily have to be on the metal itself. It could be on the mining complex, which in theory should be levered to the price direction of the metals themselves, right? As you guys have done great work over the years with me, educating people on the basics of options. But I think the key thing to underscore there is if you haven't really used them yourself, to the point where you're pretty facile with them, rather than figure this out on the fly on your own and risk making all of the rookie mistakes. If you're thinking about hedging using options, get the guidance of a good professional financial advisor who is very well skilled in them and leverage their expertise on this. But to your point, Mike, about buying, the insurance, it's like you buy fire insurance on your home. You're thrilled that you don't need to use it, right? You're happy to spend that money and not need it, right? So if you're thinking, hey, look, silver at 72, for example, it just seems it's moved so far so fast. I'm worried about a snapback. Well, you buy some insurance against that. If the snapback doesn't happen, well, then you're enjoying all those gains of your silver having run up to $72 an ounce, right? But if it does, if silver drops into the 50s, you're all of a sudden super glad that you bought that insurance. So, anyways, folks, if this is something you might want to learn a little bit more about, talk to your financial advisor, or if you don't have a good one to talk to, feel free to talk to John and Mike directly, and I'll remind you how to do that at the end of this video. John, coming back to you. So, we're talking about, in this case with the precious metals, how to keep the gains that you've had. The investing game kind of follows a progression, right? First, you got to earn the money, then you got to save it, right? You got to put it to work by investing it, then you got to grow it, right? This year, a lot of people were able to grow it, right? They whether you were in the hyperscalers on the risk on side or whether you were in the precious metals on the risk off side, like you hit some great gains. So now you're in the keep it phase, right? How do I not let this windfall kind of slip through my fingers? Uh, Talk for a moment just about how you guys as a financial advisor help people think through that. And then I want to ask you both about the last phase of capital, which is using it. We spend so much time trying to figure out how to make the number go up on our investment balances. But that's not the end game. The end game isn't to die with the biggest number. The end game is to actually use that money for quality of life. So we'll get to there. But first, can you just talk about helping people on the keep it? Hey, I've gotten some great gains. How do I not screw it up?
Yeah. Well, so first of all, even though this year's returns across many asset classes have been quite nice, that doesn't mean every investor has enjoyed those. In fact, we've talked to plenty of folks who got scared out of the market in April because they were overextended, they were overinvested in the market to begin with. And when we saw all the scariness about Liberation Day and the market sell-off, some people ran for the hills. And we're feeling this sting of getting shaken out. And there's a combination of two things, panicking, but also being more heavily invested than they probably should have been in the first place. So that's the first thing. Psychology is by far the hardest ingredient in this whole thing. Markets are hard enough, but throw in human psychology makes it, infinitely more difficult. So yeah, the keeping it, well, first of all, is they're smart, well, reminding folks that this money is there for them to use, right? One of the privileges we get, we're very hands-on managers, but we're not sitting behind a computer screen showing up on CNBC making market prognostications. We're talking to real people. We get a privilege of talking to them about really personal things about their life. Sometimes they're joyous things, sometimes they're challenging things. And you know, we in some ways serve the role of a counselor. And I don't want to, I want to be humble in using that. That's a very esteemed role or title to bestow on oneself. But yeah, a lot of times we're talking about the human aspect of their assets. And it's as simple sometimes as reminding folks that it's okay to book some gains. It's okay to pay some taxes. It's better than losing those gains. And so what if you pay some taxes? Your money is enabling you to do the things in your life that you want to do or should be able to do. So it's a combination of that. It's helping them understand that they've already many of our clients have built a very sound financial footing. It's okay to say, I don't need to get the very top of a blow off top market if that's what's going to happen. You should not feel ashamed if you lean in a little more conservatively. If you feel like your biggest concern is incurring big losses, because the economics of loss are unforgiving. People forget that simple math. You lose 10%. No one wants to lose 10%. I can tell you, even years where we've been down small single digits, it still hurts. They don't like to see, understandably, their accounts be down. But so long as those declines are shallow, they're very easy to come back from without Herculean efforts. 10% drawdown requires an 11% subsequent return to get back to even. Take that number up to 50% drawdown, you need a 100% subsequent return. That's simple math that people sometimes fail to remember. So the math is easy. The hard part is the psychology. So a big part about what we do is reminding folks that your return over the next 3 months is not what matters. It's what happens over the cycle of your lifetime, frankly. And mitigating or diminishing the amount of downside for most people, especially in their retirement years, is as important, if not way more so, than getting the maximum upside. And that's a analytical experiment, but it's also a psychological one. So we try to weave those two things together to help clients be unstuck, if you will, when it comes to that.
Okay. All right. Well, look, I mean, I've talked a lot about this in the past, so I won't continue to hammer it too much here, but the discipline that working with a good financial advisor brings the average investor is super valuable. And a lot of times it's the unsexy stuff, right? As you're saying there, John, right? I mean, it's just the rebalancing. It's just the things that, it's the person to say, hey, look, I know you don't want to pay taxes on these gains, but be fortunate you have the gains, and lock some of these gains in, because gains on paper don't necessarily always stay gains, right? So you want to take some of these unrealized gains and make them realized ones to make sure you actually get the benefit from them. So that, and also just having a process and a structure that oftentimes removes the emotional wanging around that our human brains do with us. So anyways, again, thank you and kudos to you for all the work that you've done over the years, for the many the many clients that I've sent over to you guys over the years. All right, so just to kind of bring this conversation to a meaningful, and I think a really practical close. So we're having this discussion. It's Christmas time. Hopefully, hours after you guys get off this interview with me, you're going to be sitting down at a table with your loved ones and really experiencing what true wealth is, right? And I talk a lot in this program about how money is a means to true wealth. It's not true wealth in and of itself. And true wealth really boils down pretty simply to quality relationships, living with purpose, and having good health. And, right now I've got this stupid cold, so I'm definitely being reminded about how important having good health is. It is keeping me from spending time with my family and my loved ones, because I don't want to, give my family, especially my wife's, parents who are in their 80s, whatever I've got. So it's keeping me. So I'm actually getting a real time reminder of the importance of these real wealth things. So At the end of the day, we're all working to get our financial wealth as high as we can get it, uh, not just to have a big number on paper, but to be able to fund our life's goals and dreams. So, can you guys just talk for, just in providing some closure here at the end of the year, how do you guys work with people to help them uh, crystallize what those goals and dreams are and put together a plan to get there and then help remind them, hey, you're focusing a little bit too much on just the number going up. Now's the time to actually focus on taking that number and doing the things you want to do in your life while you still can do them. So, I guess, John, let's go to you, but then Mike, we'll let you answer this as well.
Well, yeah, Adam. So certainly, we as individuals have our own goals and aspirations, but our clients are their own unique people, and our job is to help them and realize their own unique desires, right? Not to impart our views on things necessarily, but I'll just give you a glimpse of the kinds of conversations I know Mike has had, and everybody in our team has these conversations nearly daily. In just the last handful of days.
Sorry to interject, but if you include in your answer here, like I'm going to guess, and correct me if this is an incorrect assumption, but a lot of times when people, approach you initially, they might not be crystal clear on what their future goals are, right? They might need some help in actually getting all that clarified and then quantified, correct?
Absolutely. Absolutely. That's a big part of what, so we have some financial planning software that we can and oftentimes use with folks. And uh, I would first say that these are just black boxes. They can be very improperly used with the assumptions going in. For example, assumptions about returns going in. I would say probably 9 out of 10 financial advisors that are using these are making some outlandishly optimistic assumptions about returns, and that's not good because it's not grounded in reality. So these tools are fine as long as they're used with doses of reality. We have tools to walk clients through and analytics on those kinds of, hey, resources versus goals, and hey, do things balance out? Are you going to be okay? So we have as good a tools as any firm, I would say, but it's the application and the exploration and tire kicking of the assumptions and the framework that I think is really where the value comes. So, so for example, and like I'm going to go probably not on a limb here. Most households that we serve, there's oftentimes one spouse that is more in the driver's seat, if you will, than the other in terms of financial decisions and wherewithal. And sometimes there is a unintentional, the spouses may be all well loving and caring for each other, but there's this unintentional gap in understanding and even ability to articulate what each spouse wants. So oftentimes the most valuable conversations we have is when we have spouses together and we're talking to them. Hey, let's talk about your goals. Let's put some price tags. And oftentimes it's the first conversation they've really ever had. Again, not to over value or overemphasize our role, but it's kind of it's really heartwarming actually because you get to see the spouses look at each other and say, you know what? It's kind of crazy, but I don't think we've really had this conversation before. I'm glad we are finally, and oftentimes you hear things and you'll see one spouse's eyebrow go up saying, really? That's how you feel? Like, wow, well, why don't we talk about this earlier? So, I mean, again, I don't want to emphasize our role in unlocking those things, but that's a huge part of it. And sometimes it's just giving people permission. Sometimes the fear they have keeps them from doing things they really want to do. In just the last handful of days, we've processed a bunch of folks' requests to donate funds to charities sometimes, and we help them in smart ways to do that, whether it's through qualified charitable distributions from their IRAs to avoid income taxes, or gifting directly of appreciated securities from taxable accounts that avoids the need to have to incur capital gains. These are all the kind of the nuts and bolts financial things that we can, optimize for them. But it starts with, helping them really get in touch with what they want to do and then give them permission in some cases that they can actually do it without having to worry. Had another conversation with, parents, and they want to help their children are independent on their own and working really hard, saving money. But they want to do some lifetime giving to not only from a smart estate planning standpoint, but also to help their children. There's a book out there called Die with Zero that many people might be familiar with. On the surface, it sounds like this hedonistic, spend all your money and die with zero. But it's more about like, hey, if you've got resources, why not use them impactfully during your life if you can, and not just at your death, right? Sometimes at your death, it's like a little too late that, other people, including family members, might have been able to enjoy those resources more positively, I suppose. So this particular couple would like to gift some money to their children to start to help them build up a further down payment for a house someday. And that's, perfectly, and they very much want to make sure the kids have the discipline that they get a mortgage, that it's not a gift of a home, but just a helper, kind of thing. So sometimes walking through those things in terms of, can we do this in the realm of our needs? Because we don't want to, kind of put your own life, your own oxygen mask on first, kind of analogy on an airplane. You don't want to starve yourself by giving too much to your kids or family or whatever, or charity. So all these things are, yeah, they're mathematical discussions, but they're just as much psychological and emotional and feeling peace with decisions.
All right. Well, a great answer. Right. Well, Mike, coming over to you. First off, anything to add to that?
Yeah, Adam, I think that we probably said this many times, and John just said it too, that we do act as therapists, financial therapists for people, and I definitely don't want to usurp the hard work or the authority that licensed clinical social workers or therapists have. In fact, frankly, if I wasn't doing this job, I think I'd like to be a therapist or a social worker. It's the type of work that I really enjoy because I can connect emotionally and heart to heart with people. But maybe it's just because of sheer life experience. And after doing this for 25 years, you get to know people. And I think that we're uniquely equipped to help people in this slice of their life, how psychology connects with money. And, like John just said, a lot of times we're meeting with a couple. And one of the two couples is the squirrel, gathering the nuts or the acorns. And the other one is the one that wants to use them or do other things. And a lot of times we can bridge that gap and help people feel like it's okay to use some because most of our clients, and I know this is probably a good problem to have, most of our clients really won't ever use most of their money. It's a human nature thing to gather as much as you can because nobody knows the future. We don't know what storms are going to come, but the whole purpose of this is to live your life. And to the extent that we can prove to people, either through our own experience and tell them, look, you've got enough, or even with financial planning software to prove mathematically, and it depends upon what type of the person you're talking to, by the way. Some people need to see the evidence, other people just need to hear somebody that has the experience tell them that it's going to be okay. Whatever it is, it can allow them to release a little bit and do some things. Put the addition on the house, redo the bathroom, go on a trip to Europe, give money to charity, like John said, give it to the kids. After all, that's what it's all about. This money is kind of not even real anyway. Our government's just making it up. So bring it down to something that is real. Bring it into your life and do something with it, even if it's little by little. Talk with us if you want to have some experience behind that based on people that have been there and have seen a lot over the years. But that's what this job is all about to me, and happy to help.
All right. Well, hopefully this has been grounding for folks in terms of what it all means in the big picture of things, right? Why are we doing this? And at the end of the day, you know, what you want to get clear on is okay, how do I want to use this money if I have been successful in everything else, earning it, saving it, growing it, keeping it, et cetera, right? A lot of people I know who watch these videos are well on their way to success there, if not already very much at success. And so, I encourage everybody during this holiday season, while you're spending time with the folks that you love the most, and you've got a little bit of a break from your usual routine and grind, that you do some reflection on, all right, well, what are the things I want to manifest in my life while I still have, good years ahead of me, that I can bring to bring into creation using the money that I've worked so hard over time to build. I mean, again, at the end of the day, money is the means, it's not the end in itself. And I presume, guys, that anybody who wants help with thinking through that can contact you guys and, leverage your guys' expertise as financial counselors and helping them kind of put that vision together if they don't have it clearly in their mind, and then, putting timelines and progressive plans into making all that happen, correct?
Absolutely, Adam. We love having conversations. No pressure. we've been fortunate enough to build a business here that is sustainable and growing, and we can truly just embrace incoming inquiries just for the natural conversation that it's meant to be. And if we can part a couple minutes of value to anybody that talks with us, that's enough reward for us. And I should say, it's not just Mike and I, of course. We have a great team that we work with. We've been very deliberate to grow our team with the kind of good people that we know our clients deserve. And we'd be remiss if we didn't give a great shout out to our team and express our thanks for our joint role together on behalf of our clients.
All right. Well, look, gentlemen, thank you for, again, offering those services to everybody as generously as you do. Thank you for coming on this week, the day before Christmas, to film this with me. Thanks for coming on this channel with me every week to share your insights with the Thoughtful Money audience. A huge amount of gratitude for you guys, and nothing but the best holiday wishes for you guys, your families, your wonderful team there at New Harbor. So folks, look, if you'd like to get some help from the team at New Harbor or one of the other financial advisors that Thoughtful Money endorses, to set yourself up, not just for hopefully a prosperous 2026, but as I was just mentioning, really clarifying how you want to use your wealth to enrich your life in the big picture, then consider scheduling a free consultation with one of these firms. To do that, just fill out the very short form at thoughtfulmoney.com. Only takes you a couple seconds to fill out the form. These consultations are totally free. There's no commitment involved. It's just a service these firms offer to be as helpful to as many people as possible. And if you can also, guys, to viewers, please join me in thanking John and Mike for coming on the channel by hitting that like button. And if you haven't already, clicking on the subscribe button below, as well as that little bell icon right next to it. John and Mike, I think this is the last recording we're going to have in 2025. So I just wish you guys and your families all the best.
I think so too, Adam. And we're really grateful for your viewers, for you primarily, but I think even more so the viewers. I think that you and I would both agree on that. Without the viewers, none of us would be here. So this platform we're very grateful for, and the opportunity to do some good in the world. Thank you, Adam, and thank you all for tuning in every week.
Cheers to that. Thank you, Adam. Happy New Year. Merry Christmas. Happy holidays, everybody.
All right. Take care, boys. Yes, happy holidays to everybody watching. Thanks so much for joining this channel. As Mike said, none of this would be possible without you, the viewers. Wishing you the best of the holidays, a very happy new year, and we'll see you soon on the channel. Thanks so much for watching, everybody.
Japanese yen is one of the worst performing currencies versus gold, which in my book is inflation. I mean, not that gold isn't breaking out already, but I think silver will accelerate. And like Phil said, for people who haven't bought gold, I guess silver will be the alternative.
For a person, yes, you always want to go seek out as much gold as possible. When a system has a lot of gold revolving around it, you only get two things. You get more jewelry and you get higher prices. So if China reveals they have 30,000 tons of gold, like we think they might, then that means prices in China in gold terms are going to be sky high, and prices everywhere else are going to drop like a rock.
25th of September, the consultation period over whether silver should be a strategic mineral in the United States will finish. They'll have to start building a silver stockpile. And we don't know how big that stockpile will be. Obviously, in the past, it was 2.1 billion ton. If there's a disruption in the supply from Mexico, which is where they're getting most of their silver from.
One of the worst currencies in relation to gold has been the Japanese yen, underscoring the growing pressures of inflation. Silver is predicted to rise quickly as a substitute for gold for those who missed it, even if gold is already starting to break out. By September 25th, the United States must decide whether to designate silver as a strategic resource. The government would have to accumulate 2.1 billion ounces, which is almost 3 years' worth of mine supplies, if it were authorized. Since Mexico supplies a large portion of America's silver, any disruption there might have a significant effect on the U.S. sector. Experts estimate that there is a 4% chance of such a situation. Mario Ineco, a famous market strategist, and Phil Lowe, a sharp macroeconomic commentator, both highlight that since April, the Dow to gold ratio has fallen precipitously, and it currently exhibits trends reminiscent of those seen in 2007 before the financial catastrophe. Long-term charts indicate otherwise, despite some people's concerns that a liquidity event may put pressure on gold and miners. It's evident that the trend is strong because banks like Goldman Sachs are now predicting that gold will reach $4,000 by mid-2026, while silver targets are already almost reached. The wider breakthrough indicates that gold's bull market is well established, even in the face of possible short-term pullbacks. As we dive into the video, remember to subscribe and tap the bell icon so you never miss an update. We value your thoughts, so drop a comment below and give us a thumbs up if you enjoyed the content.
This one here is the Dow gold ratio, and we dropped quite a bit in April when we had that beginning of April, and then it's being consolidated, and now it's breaking down, and it looks a little similar to this, and this was in '07 before the great financial crisis, but I mean, we'll have to see anyway.
One thing I may, because we were just discussing Weimar, I do want to stress that Weimar was a very unique situation because the Entente powers were not letting Germany default. They said, you cannot default, you have to give us gold. And that's what stretched Weimar out to 2 years. I want to reassure the viewers, like, I think this will be over in 3 to 6 months once it really gets going. It's going to be brutal. It'll be as brutal as Weimar, but it'll be a lot shorter.
Yeah, but in Weimar, it started taking off. The hyperinflation really picked up in the summer of 1922, and by the 1923 it was over. So it was about 18 months. And
I think this will be about 3 months. I think they'll once they start losing control of food prices, I think they'll revalue to gold.
Now, I thought commodities were going to start a bull market in the early 2020s, only because bonds, I thought were going to start a bear market, and I thought hard assets will benefit in relative terms. But we see now that banks like Goldman Sachs, who usually just push paper and derivatives, they're actually telling their clients to diversify into commodities. And they even, I think they said that they expect gold well above 4,000 by mid-2026 if the Fed's independence is damaged. So I thought that was interesting.
Yeah, I see that. Well above 4,000 by mid-2026 in the middle of your page, Mario. I see that.
Yeah, it's here. Yeah, right there.
Their calls just follow the market.
Yeah. The other couple of weeks ago, Bank of America, which is another bullion bank, they said, oh, we're bullish silver. We see silver at $42 by the end of 2026. And I thought, that's not bullish. We're almost at 42 now. So, the bullion banks, I mean, I've been following them since I started following gold in '02. And now they can't do it anymore because gold is in a massive bull market. But for example, a few years ago, if gold was like 1,500, they would say, oh, in the next few years, we expect gold to revert back to 1,000, and like so on and so forth. But now, they're saying they're bullish, but I think they're not bullish enough. And one of the reasons is these couple of charts here, and I'm going to bring them up. First one is a bit more short term. And this line here, we're going to see in the longer term chart. I think it's really important. And it was around 2,700, this line. And that's why I think we saw this pullback, in the retest. And now as well, I mean, we've broken out of this pennant or symmetrical triangle, and it's really taken off, and there's nothing like above here. So that's very bullish. I'm not saying we won't see any corrections, and then this one is the same chart, but really long term. And this is why that 2,700, in my opinion, was so important. And I was waiting for that test.
Wait, Mario, can you flip back to the other one so I can see the difference for a second? Okay, yeah, and then go to the forward. Okay.
So this is from the high in 1980 to the high in 2011. that's where that 2,700, when we're breaking out here, I thought we might see resistance at 2,700. I mean, we didn't initially because it went up quite a bit, and then I think, I'm not sure, it went 2,900 or something, and then it broke back down. I think it was after the Trump won the election. But now, I mean, we're really taking off, and a lot of people don't look at these long-term charts, and this is why I think, yeah, people are concerned about a liquidity event.
Rafi Farber, known as the End Game Investor, in an interview with Phil Lowe, Mario Ineco, and Clive Thompson, points out that China is injecting funds into its banking system through what it calls reverse repos, essentially providing liquidity much like Western repos. The government is trying to reflate its struggling economy, which faces weak exports to the US and a collapsing property market where apartments, once the main savings vehicle, are now oversupplied and losing value. This has left many Chinese households cautious about spending. While some argue China could rise as a global power, others believe its fate is tied to the West. If US consumers are broke, Chinese producers suffer too. On top of this, China holds vast US dollar reserves that may lose value, and even its large gold stockpile could backfire by pushing domestic prices higher and undermining exports. In short, both China and the West are trapped in the same fragile global system, and neither has outsmarted the other. Let's revert back to the...
This is the case. I think when China refers to reverse repo, they mean what we would mean by repo. I think they just got their terms.
Yeah, they are buying, I think they're buying the government bonds from the banking system and injecting cash into the banks. I
Yeah,
think
so
US is the other way around.
That's what we would call repo. In
Yeah,
China, they
yeah,
call it reverse repo.
yeah,
Whatever. It means they're injecting cash into the banking
yeah,
system.
yeah.
I didn't hear about this. China they're like on a different wavelength because their interest rates are going down and down and down, and the West interest rates are going up and up and up. Um, I still think that when the West falls, China falls with it because they are the producers and we are the consumers. So if the consumers fall, the producers fall too. Like if you lose your customers, you lose your income. Or if the currency collapses in which you're getting your income, then you lose your income also. Uh, why China would be injecting cash now? I mean, we know. I mean, the place is very opaque. It's still communist, except for the special economic zones that they allow freedom in, so they can supply the West with a bunch of stuff, so they can stack more dollars. But China's economy has been so fake for so long, and they still have these ghost towns and this whole real estate bubble throughout the whole country, and it's still like a very corrupt, disgusting regime. I mean, we're not allowed we don't really say that because the West gets most of its stuff from China, but that's still the reality, and it's gonna have to go.
Not very different though from our regimes.
That's true. No, I guess in the way it functions, no, but at least, I mean, the West still has an idea of individual liberty, whereas I don't think the Chinese see that as a value at all, other than maybe a temporary expedient. There's still a feeling in the West that individual liberty is a good thing in and of itself. In China, that was never there.
Things, the Chinese injection of funds, or
I mean, they want to reflate the economy. The China's suffering obviously from the slowdown in sales to America on the one hand, and secondly, the way of saving traditionally in China has been by buying apartments. So many Chinese people bought apartments, and now suddenly they're finding that the bottom's fallen out of the market because there's far more apartments or houses, if you like, than there are people to occupy it, and the population is not rising anymore. So and a lot of building companies have left these blocks of apartments which they're building and that people have paid for. They're half empty. So suddenly everybody is now drawing in their horns saying, oh my God, my traditional form of saving isn't working, and they're not willing to spend money on things. And so the Chinese government definitely has to reflate the economy. I think we're going to see more of that. I think that's just a first step, and we'll probably see more money thrown at the economy sooner or later.
Oh yeah, there's a lot of people who think that China is somehow eating our lunch, that they've somehow outsmarted us, that and I think your friend King Kong Eric Young is always saying is talking about the rest of the century is going to be the Chinese century where China's going to move to the forefront.
Yeah,
I
I
don't
think
I don't
Jim
think that's true
Rogers
at
said
all.
that too, didn't he? Jim Rogers, I think, yeah.
Yeah, I don't think that's true at all. I think we're going to see. I mean, we're all going to go down together. It's not like it's not like we're going to do fine and they're going to collapse. They are holding enormous amounts of American dollars. We took all their stuff and we gave them dollars, which we're going to default on, and so all the people holding dollars are going to be completely broke over there. Not to mention they have overbuilt their industry, and maybe some people say, well, it's better to be overbuilt than underbuilt, but they're going to have a bunch of factories with absolutely no one to sell to because we are broke. America's broke, so we can't buy any more Chinese stuff, and there's not going to be anything in China to sell. There's not going to be anyone to buy. They can maybe sell domestically to their gold holders, and gold and silver holders, but most of the Chinese are also broke because they bought, instead of going to gold, they bought a bunch of real estate. So I think, I mean, to say that if you think the Communist Party of China is somehow doing better than us, then we should not have a free society. Then communism works, right? If you think communism works, if you think China's beating us, then that means communism works, and maybe we enjoy our personal liberties better, but communism is now a better state. And
Well,
I
I didn't say that.
yeah.
I'm just
I know you didn't. There are
reporting. Yeah, I'm
Chinese
just
broke.
reporting on the injection of funds.
Yeah,
But
absolutely.
I think China, though, has a lot more gold than they tell us publicly. They've got a lot more than 2.3 thousand tons.
That's also not a good, that's not necessarily a good thing because
Yeah.
gold has, having lots of gold in a system. I'm not talking about a person because people mistake what I'm trying to say. For a person, yes, you always want to go seek out as much gold as possible. When a system has a lot of gold revolving around it, you only get two things. You get more jewelry and you get higher prices. So if China reveals they have 30,000 tons of gold, like that, like we think they might, then that means prices in China in gold terms are going to be sky high, and prices everywhere else are going to drop like a rock because we will want to sell them stuff to get their gold. Now, what's that going to do to Chinese industry? It's going to collapse it. Chinese export-based industry when prices are sky high in China. So they have all kinds of problems on their end too. It's not like they are not outsmarting us. They're not outsmarting the system. The system is stealing from everybody around the entire world. And we Americans are sitting in drowning in debt, and in China they're slaving away for American debt that's not worth anything. So they're slaving away for nothing.
Both the US and China face mounting economic pressures. Whether it's America's debt-driven push toward hard assets like gold and silver or China's struggle to sustain growth amid a real estate bust and reliance on weakening US demand. Precious metals are increasingly seen as safe havens in this fragile global system, and their rising momentum underscores a deeper shift away from trust in paper assets. Could silver's potential designation as a strategic resource accelerate its price far beyond current projections? If China reveals its true gold reserves, would that stabilize its economy or trigger more volatility worldwide? Feel free to share your feedback in the comments below. If you found this helpful video, hit the thumbs up and subscribe to keep up with our latest updates. We appreciate you being a part of this journey.
That we're still at above 2.5%, close to 3% in the US inflation, consumer price acceleration rate, and the interest rate has been being cut since 2024. And you can see gold is rising because of that or in tandem with that. So now we are in an environment where, first of all, the Fed is going to cut into accelerating consumer prices, and they're going to cut into an accelerating gold price. That was not the case. This is going to be much worse for the dollar, and it is going to be the end of it because the debt is so much higher now. The end game is coming. It is coming soon, and this time is going to be much worse than 1980 for dollar holders and much better for gold and silver holders, because this time the gains of 1980 will be held and exceeded.
U.S. inflation remains near 3% while the Fed continues cutting rates, pushing gold higher alongside rising consumer prices. This policy shift is set to hit the dollar hard, given today's much larger debt levels. Analysts warn that endgame is near, worse for dollar holders than in 1980, but far more rewarding for gold and silver investors, as this time gains are expected to be sustained and even surpassed. Rafi Farber, known as the endgame investor, is a financial writer, investor, and precious metals analyst. Recalls that back in 1980, the Fed fought inflation by targeting monetary aggregates, money supply growth rather than just consumer prices. With debt to GDP at only 32%, they could hike rates aggressively, eventually taming inflation and stabilizing the dollar. Today, however, debt to GDP is near record highs at around 120%, leaving no room for similar rate hikes. Instead, the Fed is cutting rates into rising consumer prices and a rising gold market. Unlike 1980, this environment signals a much weaker dollar and far stronger prospects for gold and silver, with gains expected to surpass those of the past. Remember to hit the bell symbol and subscribe as we begin the video so you don't miss any updates. If you like the video, please leave a comment below and give us a thumbs up.
They wanted the monetary aggregates is the M1, M2, M3 money supply. This is back at the time when the Fed was actually trying to control inflation in a classic sense. Inflation meaning the amount of dollars over the gold supply, how much the monetary aggregates are actually rising. That is inflation in the classic sense, just as they changed the inflation to the effect of inflation, which is the effect on consumer prices, just as they changed the definition of vaccine to what it was before and what it is since COVID. I'm not going to go into that now, but it's the same kind of Orwellian nonsense. But this is back when the Fed actually was not actually fighting inflation, but trying to control inflation, meaning the actual monetary aggregates, the money supply numbers, not the effect on prices. They didn't care, not that they didn't care. It wasn't their primary goal to change the effect of prices, of consumer prices. They knew that if they attacked the monetary aggregates and controlled the expansion of the monetary aggregates, they would, by extension, control consumer prices, which they did in the end, which is why we still have a monetary system as it was in 1980. So basically, at this point, the Fed is jacking up interest rates in order to control monetary aggregates. And we can see here by this chart, when they hike into the maximum, exactly when this is, I think this is early 1981 or something like that, once they see that the monetary aggregates are within the growth ranges that they prescribe, then they get control over consumer prices over here in the red, and they get control over the gold price, but this is, of course, not their primary goal. They want to control the monetary aggregates, which will control the consumer prices, which will also control the gold price by extension, and then they start cutting rates once they see that this is under control. The other reason why this is not a 1980 situation is that you can see the debt to GDP ratio. I know GDP is fake, but this is still a general relative number that does convey some information. The debt to GDP ratio in 1981, when interest rates were at a maximum, was 31.8%. This is, I think, an all-time low since Andrew Jackson, maybe. Maybe I'm exaggerating that. I didn't look into the 19th century. I can't find statistics for debt to GDP ratio in the 1800s, but you can see that this is the lowest debt to GDP ratio. This is precisely when gold was topping and when inflation, consumer price inflation, was topping out. This is why they could jack up interest rates so high, because the debt was so low by comparison to any other year from World War II, at least before World War II, the Great Depression, until now. That is why 1980, the dollar survived that turbulence. But now, of course, we are at 120% or whatever it is, the very, very near an all-time high in debt to GDP. There's no way that they can raise interest rates now, which is why they're cutting it, and they're cutting it into rising consumer prices. You can see here, this is the chart of the interplay between the U.S. inflation rate. Inflation, I mean in quotes, not really the inflation rate, but the consumer price acceleration rate. And gold you have here, I don't know why it's not in gold. What is that, gray or green or whatever the hell it is? And you have here the blue U.S. interest rate, the federal funds rate. And you can see here that we're still at above 2.5%, close to 3% in the U.S. inflation consumer price acceleration rate. And the interest rate has been being cut since 2024. And you can see gold is rising because of that, or in tandem with that. So now we are in an environment where, first of all, the Fed is going to cut into accelerating consumer prices, and they're going to cut into an accelerating gold price. That was not the case in 1980 at all. So people that say you can't compare to 1980, this is not that situation, stop using those ratios, I agree. This is going to be much worse for the dollar, and it's going to be the end of it because the debt is so much higher now. And unlike 1980, when they were cutting into a falling consumer price inflation environment, now they will be cutting into a rising consumer price inflation environment. And while debt to GDP was so much lower in 1980, it was lower than any time before World War II since the Great Depression. Now it is at an all-time high. There is nothing they can do. They have to cut into rising consumer prices because the debt is so high. Where in 1980, they didn't have to do that, and that's why they saved the dollar, and that's why they will not this time. So forget about the Hunt brothers. The end game is coming. It is coming soon, and this time is going to be much worse than 1980 for dollar holders and much better for gold and silver holders, because this time the gains of 1980 will be held and exceeded.
Rafi Farber points out that in 1980 and 81, U.S. inflation and gold prices were surging while the Fed raised interest rates aggressively to regain control. After briefly cutting rates, they were forced to hike again up to nearly 15%, when money supply growth ran hotter than expected. Only once inflation consistently declined did the Fed start cutting rates steadily, which helped stabilize the system and prevented the collapse of the fiat dollar. Now let's review the interview.
And so here we have a chart with three colors, blue, red, and some kind of yellowish, greenish, orange, whatever blah that is. You can tell me later in the comments how stupid I am at colors, but whatever. My eyeballs are my eyeballs. What can I do? So this one, which I think is the red one, is the U.S. inflation rate. This one, the blue one, is the gold price. It's not exact. And this one over here, this wobbly one is going down over here, and then back up. Blah, blah, blah. That is U.S. interest rate, meaning the Fed funds rate. Now, what was going on here in 1980? What was going on was that interest rates were going up and up and up and up because the U.S. inflation rate, the inflation in quotes, the inflation rate, meaning consumer prices were rising. They were rising and rising and rising. And so the Fed was raising and raising interest rates, but not quite. We'll go into why not quite. That's not what was happening in the next slide. This was a situation where interest rates are rising, gold was rising, the inflation rate, the consumer price inflation rate was rising. And then you have this period here where they were cut, the interest rates were cut back down here to whatever that is, I think 5%. And then they were jacked right back up to about 13, 14% right here. And we'll see exactly why this was in a second. But you can see here that the Fed was trying to quash consumer prices, not exactly consumer prices, we'll see why in a second. They were trying to quash something else. And as they were doing that, finally, when they got control of the U.S. inflation rate, when the red line started going down, that is when they consistently started cutting rates over here in this greenish, yellowish, whatever line that is. And you can see here that the gold price was falling with it as well. What I'm trying to say here is that back in 1980 and 1981, the Fed was raising rates, trying to quash consumer prices, and only once they accomplished this goal and they saw that the inflation rate was falling consistently, only then in 1981 did they start cutting rates on a consistent basis as consumer price inflation was falling, as the acceleration in consumer prices were falling. So in other words, the Fed already had control of the inflation rate when they started cutting on a consistent basis. That's what happened in 1980, and that is why, one of the reasons why, the fiat monetary system did not end in that year. This is not really a chart. This is a transcript. I will give you the link in the description below as to exactly where you can find this thing, and it's on page 7 of the PDF that I found it on at the Federal Reserve's website. This is to a staff analysis, says the Federal Reserve Board. The demand for money had been quite strong in recent months because of recovery in economic activity and in nominal GNP, not GDP, GNP, slightly different, had been much larger than anticipated. Growth of transaction balances was projected to slow significantly over the remainder of the year, in part because of the lagged effect on the demand for money of the sharp rise in interest rates over recent months, and in part because of the apparent weakening of the recovery in activity. In the committee's discussion of policy for the period immediately ahead, the members generally favored pursuit of a sharp reduction in monetary expansion from the rapid pace of recent months. And so, if we go back to this chart over here, this is November of 1980 when they started to raise rates again after cutting them over here. This is 1980s around here where I'm circling when they started to raise rates back up to the maximum around 15%. Why did they do that? Because they saw that the monetary aggregates were rising at a faster pace.
Unlike 1980, when the Fed had the flexibility to crush inflation with aggressive hikes, today's debt-heavy environment leaves policymakers with fewer tools. Cutting rates into rising inflation risks undermining the dollar while fueling gold and silver to new heights, suggesting this cycle could deliver far more lasting gains for precious metals. Could today's debt levels make it impossible for the Fed to repeat the 1980 playbook? How high might gold and silver climb if the dollar continues to weaken under current policies? Please feel free to leave a remark below with your thoughts. Please give this informative video a thumbs up and subscribe to receive our most recent updates. Thank you for joining us on this trip.
Obviously, I could adjust my silver up, a bit. I mean, it wouldn't surprise me to see 40, 42, who knows, maybe 50, right? I mean, and I didn't say silver wouldn't, I said just basically don't bet on it. I think silver is bullish at the moment. Gold at the moment, I mean, today, price of gold's down 2%. Will it be up 2% tomorrow? I don't know, maybe. But, we're in a bull market, a long-term bull market for all these reasons, and probably both metals. I'm just less excited about silver, for these reasons. But yeah, I think in both metals. And, for the rest of the year, would it surprise me if we fell short of 3,600 in gold? No, it wouldn't. Would it surprise me if we surpass 3,600 and we resume the march up and we see 3,800, 3,900? No, it wouldn't surprise me either.
Silver might fall behind gold's momentous rise, but that may leave more room to run when the gray metals rally takes off. With renewed retail interest, sustained industrial demand, and another supply deficit, silver enthusiasts expect prices to reach $40, which aligns with the average expert price forecast for 2025. His benchmark rises to $50 when looking to 2026. Gold regained momentum after losing ground in the days following the announcement of tariffs on April 2, as investors sought safe haven assets. According to the bank's economists, there's a 45% chance of a U.S. recession within the next 12 months. If that happens, the analysts said gold could hit $3,880, $3,800 to $3,900, by the end of the year. Keith Weiner, a U.S. economist and founder-CEO of Monetary Metals, points out that a recent U.S. Customs ruling, suggesting tariffs on 1 kilogram and 100-ounce gold bars, briefly sent gold futures to record highs, disrupting global bullion flows and threatening New York's role as a key price hub. Markets yanked back once the administration clarified that gold would remain tariff-exempt. Weakening global currencies, excessive government debt, and its status as a non-sovereign financial asset continue fueling its safe haven appeal. Analysts expect continued strength, despite temporary pullbacks. Volatility amid tariff uncertainty would be beneficial for gold. Central bank purchases of gold also continue to rise amid a de-dollarization push driven by the administration's tariff policy. Investors have been riding the gold gravy train all year, according to the latest gold demand trends report from the World Gold Council. Gold ETF inflows reached 170 metric tons in the second quarter of 2025, valued at nearly $400 billion, marking the strongest first-half finish since 2020. Silver prices have dropped to their lowest in over 8 weeks. Unlike gold, which thrives as a haven, silver has yet to follow suit with similar gains. Markets increasingly view silver through the lens of industrial performance, especially vulnerable given sluggish factory data and new tariffs, casting a shadow over its near-term outlook. Before we begin, please click the bell icon and subscribe to stay up to date on our latest uploads. We always value your thoughts and feedback.
Yeah, so this is one of those things where, unfortunately, there's a lot of bad takes out there in the gold community. And these bad takes all have the same recipe, which is something happened, and therefore, because something, that's going to cause the price to go up. It always leads to the price to go up. Good news, the price is going to go up. Bad news, the price is going to go up. No news, the price is going to go up. And so we thought that, when Trump took office, there was going to be tariffs on a lot of things, and there was a fear that that was going to include, gold and silver, which would have been really bad. I mean, it would destroy the futures market in the U.S. and force it to go somewhere else. And then we got clarity. No, it doesn't apply to the precious metals. Okay. And it doesn't apply to copper and some other things. Okay, great. Then, I don't remember when that was. Seems like it was a couple of months ago. It does apply to copper after all. So that's really going to kill everybody who manufactures with copper in the U.S. And, create some perverse incentives. So, cars don't use that. I'm trying to think of what really uses a lot of copper, but it'll make sense to manufacture that in a low tariff country and import it as a finished good rather than importing the copper and manufacturing in the U.S. So some very perverse incentives there. But we got on Thursday, it came out that some big trader or refiner had asked, I think it was the U.S. Customs Agency, for a ruling letter to clarify the status of gold. They wanted legal clarity so that they're not risking not paying something they're supposed to pay. And, obviously they want to make their plans and their investments. Nobody wants to invest money only to be told by the government later, actually, your investment is rendered useless because of this tariff. And the letter came back and said that kilo bars and 100 ounce bars are tariffable. They're in the category that's subject to tariffs. Well, that sent the gold market into a tizzy, because apparently that takes effect immediately. Let me talk about kind of the difference of silver versus gold. Silver is much more the working person's precious metal. And when you start to see the jobs market, which wasn't really all that strong for, blue collar, trades. Yes, certain trades at certain times, if you're in the building trades in certain booming cities, I'm sure there was unlimited work. There was a period of I'll call it the unlock whiplash after COVID lockdown was over, where, truckers, had all the work they could handle and more. But overall, the market for, people that are working with their hands or doing a skilled trade, just not been that strong a market. Now, certain niches within white collar knowledge workers like AI, scientists right now are getting these like $100 million packages. It's almost like reading about sports stars. And you read about Michael Jordan getting a package like that, and now it's like these AI guys are getting it. But silver is the savings of tradespeople and blue collar workers. And now we're seeing the job market roll over, and that's going to hit, that segment, hard. And in addition, silver has this industrial component. And if manufacturing and all those other things are rolling over because of tariffs, for example, and also because this boom is just really long in the tooth. We're basically in one long boom that was juiced up when in spring, or was it March, April of 2009, the Financial Accounting Standards Board said, you don't have to market the losses. And so the banks were able to restate their financial statements, and suddenly they looked a lot better. And that was pretty much the day that the market turned around and began to boom again. So we're in this hell of a long time, 16 years and counting of boom, which is very long by any historical standards. I think we're well into record territory. So that we could be rolling over just because of that. Tariffs aren't going to help, all kinds of other things. And so silver because of manufacturing demand falling off a bit and because of working people savers just having less to save, I would generally expect silver to underperform. Now, could silver outperform in the short term? I think there's a lot of forces building up to suggest it could. Because the asset speculative class is seeing silver now. So if they jump into it, almost anything's possible in the short term. But gold, yes, because all the currencies, remain in this horrible bear market, and every government around the world has gone all in on madness, and it's getting madder, right? So we elected Trump as a protest against the profligate, stupid spending of the Democrats. And what do we get? A big, beautiful spending bill that accelerates spending even more. And of course, gold responds to that because it's just, it's just a hedge against being a creditor to the government, which is what, if you hold the dollar, you're effectively a creditor to the government. And when the government's becoming something that embarrasses even drunken sailors, you don't want to be a creditor. Well, look around. What asset can you buy that's a financial asset that isn't being a creditor to the government? It's gold. So yeah, we're in this gold bull market. Silver, I think, medium to long term, not really. Maybe it'll keep up with gold at this point. It's not going to outperform. Short term, yes, there could be a big pop in it. That wouldn't surprise me, given everyone can see the chart patterns and say, wow, silver's going to pop. And then they'll make it pop, right? But, is the real long-term demand there for it?
Silver's resilience is evident compared to previous years. Since the start of 2024, silver has gained over 50%, demonstrating increasing appeal for investors seeking diversification and growth potential in precious metals. Renewable energy, particularly solar power, continues to fuel demand. Despite some uncertainties for U.S. renewable projects under the current administration, global solar installations are expected to hit new records in 2025, all good news for silver. The solar sector's appetite is so large that by 2050, it could consume nearly all of today's known silver reserves. Geopolitical tensions add complexity. Russia and Mexico, two of the top silver producers, face ongoing political and regulatory challenges that could further restrict supply. Silver's reputation as a safe haven is growing amid economic uncertainty. Volatility stemming from tariff threats and policy shifts since early 2025 has prompted investors to seek tangible assets, such as silver. Interest rate expectations also matter. Even if rate cuts slow, sticky inflation suggests real rates could fall. Silver is set to hit $40 this year and $50 by 2026, according to Peter Croth. The silver stock investor author credits the simultaneous rise in industrial and investment demand, ongoing supply deficits, and positive market metrics for this bold price forecast. Under the right conditions, Croth even thinks silver could explode to $300. Even famed silver investor Eric Sprott shares a similarly ambitious expectation of $250 to $500 silver. Let's redirect our attention towards the interview.
There's a point at which there isn't even necessarily an explanation. Now, the silver people will talk about structural deficits. Now, they've been talking about structural deficits since before I got into this. I sold my company in August of 2008. So we're exactly 1 week away, a week and a day away from the 17th anniversary of that sale, right? That was August 19, 2008. And when I started reading about this stuff in fall of 2008, they were talking about structural deficits for silver. Now, if the price moves, especially sharply in a short period of time, you can't look to a 20-year-old story as the explanation. It's like the left says, oh, consumer prices went up this month because of greed. Wait, are you saying there wasn't any greed last month, and this month greed came into the market and that's why prices went up? Like, if there's something that's basically a constant, greed is a constant, and the alleged structural deficit in silver is a constant as well. It doesn't explain change to the margin. So a lot of people may cite that, but at some point sentiment, takes over and then everybody, wants to buy. Yes, it's true in places like India, if gold is perceived to be too expensive, it's also out of reach, for, very large numbers of Indians just don't have. Minimum wage in India is between $2 and $5 a day. So it doesn't afford them, much if any gold. Silver is much more affordable. So, if gold becomes less affordable, there'll be some switch to silver at the margin there. That's true. And that can drive it a little bit. Silver is a smaller market. But at the end of the day, I think it's sentiment. The sentiment can be self-fulfilling for some period of time. As it was, I think there was non-sentiment factors as well in 2011, but look at what happened to silver in the first part of 2011, right? We shot up in late 2010, silver was under $20. And by, was it March? It hit peak or April in 2011, it was $50. So boom, 2.5 times. And then we spent how many years in a bear market in a silver wilderness? So the sentiment, when it turned. It was done. And that first day that silver dropped from $49 to 30, was it 35 or 34? It was like within a day. And all the smart people were like, silver's done, stick a fork in it. It's not going to recover the $50. This is not a market correction. This is wicked volatility. This is a bear market. If you have a loss, take your loss and move on. If you still have a gain, lock it in and move on. This thing is done. And it was for a long, long time. We still haven't recovered. 17 years later, we're getting closer to recovering. Could it go to 50 and beyond? You could. Will we see 30 on the gold silver ratio again? No way. To see 30 on the gold silver ratio, we'd have to see over $100 in silver. Keith Weiner, August 11, 2025. You're not seeing $100 on silver anytime soon. Not going to happen. It is what it is.
Although industrial headwinds and uncertainty surrounding tariffs may cause silver to lag behind gold in the near term, its long-term fundamentals remain solid. With projections of $40 in 2025 and $50 in 2026, silver is poised for substantial gains due to its continued industrial application, particularly in solar energy, as well as rising demand and supply constraints for safe havens. In the meantime, gold is still growing thanks to central bank purchases, safe haven flows, and a deteriorating macroeconomic environment. If recession worries materialize, it might reach $3,900. In an unpredictable global economy, both metals remain essential for investors seeking growth and safety. What possible effects might current tariff measures have on the equilibrium between the industrial demand for silver and its attractiveness to investors? If the need for manufacturing and renewable energy around the world recovers more quickly than anticipated, may silver's anticipated surge surpass gold's gains? Leave a comment below with your opinions. Please like this video and subscribe for future updates if you liked it. We appreciate you coming along on this adventure.